How's it going today, guys? So today we're going to be talking about when to sell a stock. These are the 7 situations that would occur that would tell me that it's time to sell a stock. Now, before I get into this video, guys, I just want to let you know that my stock market mastery course, that's my 17-part, 12-hour course on investing in the stock market, is back open. I had 20 openings. I dropped the details to my email list first, and I now have 7 spots left if you guys are interested in joining that. I'm going to be closing this afterwards and opening it again probably in the middle of February. As I've said before, I don't bring a lot of people on at once because I'm looking to spend a lot of time helping people and answering questions one-on-one. So my goal is not to bring on as many people at once. I bring on a few people and help them get up and running, and then I'll bring in the next group, like I said, in the middle of February. So I do have 7 spots left as of right now. If you guys are interested, the link for that is in the description below. And if you click on it and it redirects you to a page where you can join my waiting list, that means that those 7 spots have been taken. But make sure you join that email list to be notified of the next openings for my course. But anyways, let's get into the video and talk about the 7 scenarios that would result in me selling my position. Number 1 on my list here is if the target price is met. Now, I do hope that you guys, when you invest in a stock, have some kind of plan or some kind of idea of what you want to sell that stock for in the future. And in my case, I always do this when I'm investing in a stock. I have an idea of what my target price is, and I always try to make sure that I'm holding stocks long term. That's going to be listed later on here on my list here, but I always look to hold stocks for a long period of time, at least 1 year. That way it falls under a long-term capital gain. But after that point, if my stock hits my target price, then I'm going to be selling that stock. A lot of people make the mistake of getting greedy at this point. They hit their target price on an investment, but then they go, oh, but is it going to keep going up? What if I hold it for even longer? What if I can make even more money? So what I always tell people in relation to this point is that a bird in the hand is worth 2 in the bush. You should not get greedy when it comes to an investment. If you set a target price and your stock hits that target price, then sell that stock. Do not get greedy, because at that point you're going to start trading or investing with emotion. And a lot of people make the mistake of riding a winner into a loser because they think that that stock price is going to keep on climbing. What I always say is, if your target price is met, take profits off the table and wait for another opportunity to come around. I don't ever stay in an investment longer than my plan, and that is why I am successful when it comes to investing. A lot of people make the mistake of holding on to an investment even after their target price is met because they're hoping to make more money in the future, and oftentimes that isn't the case. So I always recommend people set a target price when they open a position, when they invest in a stock, and once that target price is met, you sell, and you recognize that profit, and maybe you wait for another buying opportunity if you want to get back into that stock. Number 2, the second reason I would sell a stock is if there's a 20% plus return in the short term. So if I invest in a stock, and let's say even if it's going to be a long-term investment, and all of a sudden, let's say in the short term, in the next month or so, that stock is up more than 20%, then I'm going to sell. Even though it's a short-term capital gain, I'm just going to take the profit because it's not common that you're going to invest in something and see a 20% return in the very short term. So anytime that happens, it's only happened to me a couple of times, if I see a 20% return, then you better bet I'm selling. I'm going to take profits off the table. And again, maybe I'm going to wait to get back into that stock or just look for another opportunity. But anytime I'm up real big in the short term, I'm going to sell. I'm going to take that profit, and I'm going to, consider it as luck at that point and say, I guess I made a good investment, but I'm not going to get greedy and try to turn it into a 30 or 40% return. If I have 20% in the short term, guys, I'm going to be taking that profit. Number 3 on my list, guys, is anytime I have long-term capital gains. So I've talked about this in a couple of my videos, the difference between long-term capital gains and short-term capital gains in the stock market. And anytime I have long-term capital gains, I'm going to be considering selling. That's when I've held an investment for longer than 1 year. And any gains recognized from that investment are going to fall under the lower tax bracket. Now, the tax advantage in the US can be as high as 20%, depending on what tax bracket you fall into. So you guys should consider holding your investments long term at the very least. But that's another reason I'll sell an investment, is if I have significant gains and I'm falling under a long-term capital gains. And if I'm long-term capital gains at that point and my target price is met, then I'm going to be selling. I'm going to be getting out of that investment and taking my profits off the table. Number 4 on my list is if there is a buyout or if that company is acquired, because what often happens is there is what is called an acquisition premium. That is when the company buying out this particular company is going to be paying a premium on those shares, and as a result, you're usually going to see the share price increase in the very short term, usually in one day, anywhere from 20 to 50% depending on the premium paid for those shares. So this has never happened to me. Hopefully it does someday. I'll be investing in a stock and I'll wake up one day and find out that some bigger company has bought them out and the stock is up 50%, you better bet I'm going to be selling. I'm going to be taking my money off the table. So I've never had this happen to me, but maybe you guys have invested in a stock that has been bought out. But usually when that happens, guys, that's a good time to take profits, recognize that capital gain, and maybe go out to dinner and celebrate, because that's a very good day as an investor, is when your company is bought out by a larger company. Usually you're going to see that stock go up anywhere from, like I said, 20 to 50% or more, sometimes in just one trading day. Number 5 on my list is at the end of the year. That is often a time when people sell stocks. Now, I didn't sell any stocks at the end of this year, but some people do end up selling some of their losing positions at the end of the year to offset some of their capital gains, or maybe they had a really bad year and they want to recognize a capital loss and deduct that from their taxable income in the following year. So maybe it's the end of the year, it's in December, and you decide that you have a losing position, you don't want to hold on to it anymore. Maybe your best situation or your best scenario at that point is just to cut your losses, sell that particular investment and offset your capital gains, and then use that money elsewhere in the following calendar year. You don't want to be holding on to dead money. You don't want to have your money tied up in something that's not going to be making you more money. And sometimes you just have to lick your wounds and say you made a bad investment, and you're better off just recognizing that loss. That's never something I've done myself, but I know a lot of people do end up doing that in the month of December because they can write it off the following year and again use that money elsewhere, or just use that loss to offset some of their capital gains from other investments in that year. So that's a time you're going to see a lot of people selling stocks, is at the end of the year when they can get stuff off the books and then deduct it from their taxes or lower their capital gains from other investments from that year as well. Number 6 on my list is anytime that I see declining fundamentals. Now again, luckily this has not been something that has happened to me, but if you're investing in a company and you're keeping track of the fundamentals and you're seeing increasing debt, or you're seeing liquid assets decreasing, or you're seeing less earnings growth or less revenue growth, that might be an indicator that the company is not performing very well. Now, ideally, you're somebody who is keeping track of these things by reading quarterly earnings reports and things like that, so you would be able to catch wind of this before it was reflected in the share price. A lot of people are not paying attention. A lot of people don't read earnings reports, and if you're somebody who is very active with your investments, you read the earnings reports, you pay attention to things like the balance sheet, and you're seeing changes taking place, that might be a red flag for you that says, you know what, the fundamentals of this company are declining. The financial health of this company is declining. I think it's time to get out of this investment. So if you're paying attention to things, maybe you're able to break even on that investment, or maybe even get out before the losses take place when that hits the street, and then you're seeing the retail investors and the herd investors selling off as well. So anytime you see declining fundamentals, that might be an indicator that you should sell that investment before everyone else starts to sell it as well. You don't want to be seeing the financial health of a company declining, or if you're seeing flat or declining revenue growth, again, that is a very bad sign for that investment. And then number 7, this one goes without saying, if the company goes bankrupt, then you should just sell those shares. They're going to be worthless most likely in the future. You might as well sell them, recognize that loss for that tax year, and yeah, hopefully you guys never end up in a situation where you're investing in a company that goes bankrupt. Ideally, you would be paying attention to the fundamentals. You'd be seeing those declining fundamentals, and you would know that you got to get out of that investment. You're not going to be involved in that anymore. But if you're in a situation where maybe you weren't paying attention, or maybe you just kept holding on to it because you were thinking it was going to recover, and then that company announces bankruptcy, you should probably just get out of that position. You should probably just take any money you can. If you can get anything out of it, you might as well sell it, because odds are it's going to be worth nothing in the very short term. But anyways, guys, that is all I got for this video. Let me know what you think in the comment section below. I'm curious if you guys have ever held a company stock after they had been acquired. What did you guys do? Did you hold on to that stock, or did you sell it for a massive gain in the short term? Let me know what you guys did with that there. Again, if you're interested in that stock market mastery course, like I said, guys, I have a couple of spots left open. The link for all of that is in the description below. But I thank you guys for watching this video, and I hope you have a great rest of your day.